Here's something they won't teach you in school. If you type in debt market chart, you'll get something like this. The US 10-year yield treasury chart. So what is the 10-year treasury yield? The treasury yield is the effective annual interest rate that the US government pays on one of its debt obligations expressed as a percentage. Here's the important bit which correlates to everything. The treasury yield also shows how investors assess the economy's prospects. The higher the yields on long-term US treasuries, the more confidence investors have in the economic outlook. But high long-term yields can also be a signal of rising inflation expectations. So, in layman's terms, and how we can correlate it with the stock market, which is a derivative of the debt market, the 10-year yield goes up, capital from the debt market is fleeing. That's a fair trade. When the 10-year yield goes down, more capital is entering the debt market, which then overflows into other derivative markets such as the stock market. And yes, cryptocurrencies do respond to the debt market fluctuations as well. Large fluctuations in the debt market, such as in 2020 and recently in June, whether going down or up, are often seen as unstable and spook the markets. It's in central banks' interest to keep the 10-year yield stable, and they regularly manipulate it. Remember, when looking at the stock market, it's actually a derivative of the debt market, aka the 10-year yield. Keep this in mind when looking at the stock market fluctuations. Remember, the debt market is what truly controls it.